Trading psychology is one of the most important aspects of trading, or for that matter, even for investments. Psychology is very important, and we have to elevate our trading psychology. So, if we can do this, then we can dominate. We can dominate ourselves so that we can improve our results. We don't need to dominate markets. We cannot change markets if we are retailers. Market makers are different people who have huge amount of money, and they can change the markets. They can dominate the markets. What we have to do is we have to dominate our psychology, improve our psychology, and go with those methods which are as per our mindset, as per our psychology. We need to understand what is our psychology. Know yourself is most important. Then understand the markets. We don't change markets. We act in sync with market or act against market and expect that market will work in our favor. But we cannot change markets anyhow. Mind of a trader is one of the most important aspects. A retail investor or a retail trader is like a pawn. If the moves are right, then pawn can become a queen. But if they are wrong, then that pawn will be sacrificed. So we have to play right moves with right psychology. We have learnt many strategies, but there are many things which are beyond strategy. Most important is emotions. Emotions impact our decision making. Our trading decisions can be highly impacted with emotions. These emotions can be related to financial markets, these can be related to our personal life, these can be related to our family, these emotions can be related to our physical state. If we are not well, we are not able to take good decisions. If there is lack of financial support, or if we are not financially independent, then we may not be able to take appropriate trading decisions. I have seen many people want to make large amount of money, and that's why they come to markets. They don't have any other source of income. These people feel that markets are very easy way of making fast money. They come here and lose everything. Why 90% people are losing money? Because they feel that markets are the source of income, and they can make huge amount of money with minimal efforts. That is wrong. The person who has consistent income and who does not have dependency on market income, that is the person who can make huge amount of money from share markets. But if you are entirely dependent on share market for your family, then it may be really difficult to make good amount of money. It takes lot of experience, lot of emotional control. So those who don't have anything to lose, they can make huge amount of money. For example, somebody who had just started at age of 14, 15 years, and he has nothing to lose, he just wants to explore. That boy can make huge amount of money because he has nothing to lose. He will get some money from his parents. If he loses that money, it's okay for him. But if his family depends on it, a person who is 30, 35 years old, and his family depends on his trading income, then there will be lot of stresses. If he faces one trade loss, then his psychology may get impacted. If he faces five back to back trading losses, then his psychology will get more impacted. And if the month goes in losses, he is not able to make any profit. How will he run his family? These issues can create big psychological impact. So, those who are dependent fully on trading income may not be good traders. It may not be necessarily good proposition. They may not make huge profits because their psychology will be affected. But if there is some professional who is making good amount of money from his profession, and he is risking 10% or 5% of his income in some trades, then that person, even if loses those 5%, will not get impacted in significant manner, and that person will be in better situation to make more money. So emotions are important, and we have to look beyond strategies to master our mindset. Psychology is very powerful, and we have to control emotions for consistent execution. Many times price is falling and people buy because they feel this is the bottom, this is the bottom. Many times prices are rising and they feel this is the top, they start selling. When the markets are strong, instead of falling, prices can continuously go higher and higher. Sell only when your system says that you should sell, and buy only when your system says this is the time to buy. To control the emotions, we need consistent execution. And for consistency in execution, we need a specific method, specific rules. These rules can be discretionary rules, this can be rule based, this can be based on indicators, this can be based on observations. But there has to be some rules for execution. And when these rules are fulfilled, then execution must happen without worry of what will happen to the result. It can be a bad trade, it can go into losses, or it can be a good trade and it can give huge profits. Anything is possible depending on market conditions. But execution has to be practiced. So, to practice the execution, we need to build discipline. And journaling and analysis are keys to building discipline. I have already shared a trading journal. In that, you can add your trade entries, exits, stop losses, you can add charts, you can add various things, and then analyze these things. This will help in building the discipline. Remove the factors which are creating more losses. Keep taking those trades which are giving you profits. Self awareness is very important, and that is your trading edge. We have to know ourselves. We have to improve our decisions and we have to reduce the losses. So, how can we know ourselves? We can know ourselves from our trading journal. We have to understand what are the emotional triggers which are causing losses. We have to recognize the emotional triggers which are leading to wrong decision making. If you make a loss, try to remember in which situation you had created that trade. Was your mindset right? Did you take that trade while driving? Or did you create that trade after having some emotional trauma? Or were you perfectly alright at that time and you made the decision based on charts with sound mindset? So, this will help you make rational choices even when you are under pressure. If you are not able to make rational choices under pressure, then leave it. Don't take the trade. Wait for appropriate opportunity when your mindset is cool, when you are not under pressure. And reduce the losses by avoiding impulsive actions driven by fear. If you have fear of losing money, then stop. Take a pause. If you have any other emotion which is causing you losses, stop and wait till those emotions are past. So, journal your trades and understand these facts properly. Trading method is very important. If you don't have a trading method, then how will you improve your psychology? Based on which factors will you take decisions? And how will you understand whether it is working or not? Having a method is important. Journaling results of that method are important. These things are very important to develop a psychology. If you don't have a good trading method or good investment approach, then you cannot improve your psychology. So, first thing always is having one method. It can be a fundamental method, it can be a technical method, it can be combination of fundamental with technical, but have one method and define your approach. Choose the method which suits you. I have given you so many methods only based on tape reading tool. You can buy first green candle, you can buy on retracement, you can use hybrid approach. There are so many methods. So define your approach, what you are going to do, write the rules. I have given you rules also. So modify those rules as per your mindset and choose a method which suits you and commit and practice. Stick to your chosen strategy. Don't hop around. If you have selected specific rules, then go with those rules for at least 21 trades. Write this, at least 21 trades. You will take those trades based on those rules. So, this can be done in stage wise manner. First, go with bar replay. Take charts, old charts of some stock which you want to trade. Go to past data and do bar replay. Take trades with bar replay using those rules and every time write down what was the result. Did you make money? Did you lose money? What happened with that trade? That will give you some experience. So this is first step, this is first type of practice. Then here emotions are not involved, only discipline is practiced. Why emotions are not involved? Because money is not involved. So you will not be stressed once you do this bar replay method, then go to next step. and take paper trades or take trades with small amount of money. If you can risk 10,000 rupees, then just risk 500 rupees or 1000 rupees and take trades. So take 10 trades or 20 trades with 10,000 rupee risk. That means divide the 10,000 rupee risk in 10 or 20 different trades, so that you will automatically gain that much of experience without losing huge amount of money. Instead of going with one trade of futures, take that trade with cash and take 20 trades or at least 10 trades. So even if all the stops are hit, you will understand that this method is not working, and you will try to understand what are the changes required. If the method works in 5 and doesn't work in 5, even then you will not be losing any amount of money. But if you take one large trade while learning, then what will happen? Just one big loss will hamper your confidence. It will give you setback and you will not dare to take next trade. So remember this, divide your initial risk in 10, take at least 10 trades. Some of them will be profit making, some of them will be loss making. You will gain valuable experience without losing large amount of money. So this way, commit to practice, refine and adapt. Adjust based on performance analysis. You have to perform, you have to journal and you have to analyze that performance. This helps in big way in improving the psychology. So as I mentioned, mastering bar replay and paper trading is very important. Practice makes habits. People say practice makes man perfect, but if you practice wrong things, then you will get perfect in wrong things and you will keep making those mistakes, you will keep losing money. Don't become perfect in losing money, become perfect in making money. So practice makes habit. Try to make good habits. Simulate trades without real risk, and then once you are practiced to taking those trades, keep taking those trades in real money. So build muscle memory first. Don't try to think too much during the trades. Think whatever you want to think before taking the trade. Don't press the button unless you are confident. And once you are confident, don't hesitate. Just stick to your rules after the trade has been taken. If you have bought something and kept a stop loss, just exit when the stop is hit. If you later on understand that probably my trade was wrong, just exit immediately, don't wait. And if you have taken right decision and taken a good trade, just follow the rules which you had decided before taking the trade, unless there is some significant change while the prices are going in your favor. If they go against you, act immediately. If they are going in your favor, you can refine your reactions and continue with what you are doing, or continue to hold on the position. So identify and correct your hesitation points. What can be these hesitation points? When prices are falling and you want to buy, many people like to keep buying when prices are falling. And for many people, hesitation point can be buying when prices are rising. Identify your hesitation points. For me, what used to happen was, when prices were moving higher, I looked for selling opportunities and looked to sell short so that I will make profit with small stop loss. But prices kept moving higher, hitting my stop loss. And when prices were falling, I used to look for buying opportunities. I used to look for demand areas, buying points. And those buying points used to break because the trend was down. I identified these things. I created my indicator. From that indicator, I understood that there can be better opportunities to buy when prices are moving higher. And if the trend continues, I can make much larger amount of money instead of going against the trend. So this way, refine your reactions by identification of your hesitation points and your mistakes. Trading journal is your most powerful tool. You can create a chart book. I have told my mentorship group people to create a chart book. What is meaning of chart book? Create those charts which have given good entries, which have given good exits. I have already created a chart book of 50 charts. I had shared that. So that kind of chart book where you have taken a trade and it has failed, that will make a failure chart book. Those kind of trades which made good profits, that will make profit making chart book. So this way, if you create chart books where you are keeping the charts of failures, you are keeping the charts of your losses, you are keeping the charts of your average profits, and you are keeping charts of your massive profits, you are keeping charts of your small losses, you are keeping charts of your large losses. By analyzing these things, you will understand that there are some specific patterns which you follow. So, identify these patterns and stop those patterns which are giving you losses, especially big losses, and continue following those patterns which are giving you big profits or even moderate profits, but stop big losses. So this is very important. Market can give you small loss, big loss, break even, small profit and large profit. Only big loss is the problem. Small losses are not problems. Follow the rules, exit at small loss. That will be recovered in one big trade. Even 20 small losses can be recovered in one big trade. But one large loss cannot be recovered even after 20 good trades. So this is very important. Avoid large loss. This will also help you in improving decision making and making better choices over a period of time. So journaling is very important. Start journaling today. Start making your charts, save those charts properly and improve yourself. We have discussed many different trading approaches. Contrarian trading approach, which is against the current trend. It is for looking over extended market conditions, spotting the opportunities in bear markets. So these can be different approaches. There are contrarian people. Identify whether you like contrarian approach or trend following approach. If you like contrarian approach, there is nothing wrong. But journal your approach and improve that approach. It is important. Mean reversion is riding the waves when the prices are within range. Identify range. Some people use indicators for this. Riding the waves means not long waves, it is short wave. Prices have gone significantly, they will come down. So that is riding the wave. Actually, it is riding against the wave. So if you like mean reversion approach and want to take frequent trades, it is okay. You can identify your approach and take trades. What I prefer is trend following method. Riding the momentum is important, and that can be done using Mark Minervini VCP kind of trades or I start trades, I start entries, which we have discussed in mentorship group. When the prices are in momentum and there is a opportunity with small stop loss, you can grab that opportunity and you can make good profits in short time of trade. But if the trend followers can become early birds, then they can catch the huge trends. So always be on lookout for first bullish change and first green candle instead of those trades which have already created 60-70 green candles and after that you are taking a new trade. Better is when there was downtrend with many red candles, after that prices have turned to green, that is the right time to be a early bird. Now suppose price has gone up like this, it has created a bearish change with yellow color and again it has created a bullish change. Then retracement at this time may be good, may not be good. It may give good profit again, but it may hit the loss also. But if earlier trend was down and here it is first green change, from here it is better to capture the trend instead of capturing the trend when it is too late. When is it too late? When first green has happened here and after that lot of red candles are not visible or lot of sideways action is not visible, then it is already late. So if there are more than 60 candles in up move like this, which is going up, not sideways move, sometimes it is possible that sideways move may also happen, but if there is up move like this and there are more than 60 candles, try to avoid those kind of trades. Try to be early bird. Now let's come to position sizing. Protecting your capital is very important. For that, stop loss, understanding stop loss, and creating appropriate position size is very important. We have to manage the risk and reduce our position size when we are uncertain. How to understand that we are uncertain? If we are taking trades, we have taken 5 trades, and out of that, 3 trades, 4 trades have gone into losses. Just one trade is giving us profit, or all 5 trades have hit the stops. Whereas in normal conditions, usually 2 or 3 trades give profit and 2 trades give losses. If it is giving loss in 4 trades or all 5 trades are in losses, that means market condition is not in our favor. That is the time to reduce the position size. And you can increase the position size when every trade is working out. So suppose you have taken 5 trades. Out of those 5 trades, all 5 are in profit. Don't hesitate, take 6 trades, 7 trade. That can give you larger profits because market is in your favor, conditions are working as per your situation, as per your method. But if you have taken 5 trades and all are going in losses, manage the risk by reducing the position size. Instead of taking 5 trades, just take 1 or 2 trades and reduce the position size. If you are deploying, suppose, risk of 10,000 per trade, instead of that, just take a trade of 2,000 rupees or 1,000 rupees per trade. In this manner, you can reduce position size and manage your risk when market is not favorable. Avoid emotional trading at any cost. Don't chase losses with larger bets. Suppose you have made loss in 5 trades and loss is 50,000. To recover that loss, don't take a trade which has stop loss of 50,000 rupees. So that just one trade will recover complete losses. That will give you much larger emotional trauma if that trade goes in loss. So many times people do this. This is called as martingale. Increasing position size when you are in losses and just one trade will recover your losses. But it is like gambling. If you keep losing money, then every next trade will keep making larger losses and your losses will compile significantly. Avoid emotional trading. Don't chase the losses with larger bets. Reduce your position size when it is not working for you. Preserve the capital. You must stay in the game to get more opportunities. You should not lose more than 5% capital. Otherwise, it will be difficult to recover that capital. To recover 5% loss, you have to make 6% gain. To recover 10% loss, you have to make 11 to 12% gain. To recover loss of 20%, you have to make gain of 25%. So one has to preserve the capital to stay in the game and get more opportunities. Better opportunities will come in future and you will be able to recover the loss. To manage the risk, placing a stop loss at appropriate place is important. Define your exit points before taking the trade and limit the potential losses. This will reduce emotional attachment with the trade. I have already given you tape reading tool method. By using that method, you can use stop loss on closing basis. I have also explained stop loss based on hard stop that can be placed below previous swing below the buying area. This way you can define your exit point using tape reading tool. If you want to use any other method, you are welcome to use, but strategic stop loss placement is important. Managing the risk per trade is important. Define your risk tolerance before taking any trade. Suppose you are comfortable with 0.1% per trade, 0.1% of your total portfolio, or 0.5% of your total portfolio, then you can take that risk and take a trade. Accordingly, calculate the position size, adjust the trade based on risk per trade. This ensures capital preservation and long term survival in the market. Many people ask when should they take a futures position and is it necessary to hedge them? Why is it not necessary to hedge any futures position? I have explained. If you buy futures and buy put to hedge it, it is same as buying a call. So instead of hedging your futures position, just go ahead with buying a call. That is simple. But don't hedge your futures position by option buying or option selling. So selling a call is not a hedge at all, and buying a put is a hedge, but it just mimics buying a call. If at all you want to hedge for overnight risk, then you can buy put at end of the day and exit that put at start of next day. But I don't like this method. This can be done only when there is some event expected, like results are expected overnight. At that time, you may take this kind of decision. But if your trade is as per analysis, then most of the times, even if there is gap, it happens in your favor. So one can take a futures trade if it is allowed in cash trade. Means if you want to buy Reliance futures, Reliance lot size is 250. If the stop loss is 100 points in Reliance, then consider this. Can you take a loss of 25,000 rupees on your portfolio? If you can take loss of 25,000, you can go ahead with one lot of future. If you can take risk of 1 lakh rupee on your portfolio, you can take 4 lots of Reliance futures. If you can take risk of 5 lakhs rupees in one position in one trade on your portfolio, then you can go with 20 lots of futures. So either go with cash or go with futures. It depends on how much is the risk per trade and does it fit as per your portfolio size. If it is not fitting as per your portfolio size, don't try to take that trade and don't try to hedge it. So calculate position size, adjust based on risk per trade and preserve your capital. Portfolio risk is the bigger picture. What we discussed was per trade. Then we have to discuss as per portfolio. Define maximum exposure at a time. What is meaning of maximum exposure? If you want to take trades in commodities, do not take trades with more than 20 or 30% of your capital. Let the 70% capital remain idle, but don't take trades just because the capital is available. Commodities have high leverage. So in that case, you can just deploy smaller portfolio and reap the benefits. If you deploy more than 50% of your portfolio in commodity trades, it will expose you to larger losses. The risk will be significant. Same for futures also. If you are deploying large amount of trades in futures and if on some bad day something happens and everything goes in losses, your loss will be significant. You may lose even 50% of your portfolio within few days. So limit your overall risk across all positions. Decide that I won't risk more than so and so percentage of your portfolio. For some people it may be 1%, so for some it may be 5%, for some it may be 10%. I like to keep my risk of 5% at the most on my portfolio. If I have deployed positions which are exposing me to 5% on my portfolio, I will not deploy further capital. But if the positions are in profit, then I can take further more trades. So diversification matters and people spread across different assets. You can do that. At any cost, avoid over leveraging or it can be suicidal. Over trading always has pitfalls. It leads to emotional trading trap. There are impulsive actions which lead to poor results. I experience this even now. Emotions are hard to control. It comes with practice. But nowadays, even if I go for over trading, I reduce the position size significantly. So with experience, we learn these things. There can be burnout and frustration. Constant trading can lead to mental draining. If you are continuously watching the screen and continuously monitoring different stocks, it can lead to lot of stress. Focus on quality setups. If you have 10 setups and if you are watching 100 stocks, it will be lot of time consuming. Focus on quality setups, those setups which give you best risk reward or those setups which give you very good profits or high success rate. Follow only those setups. Even though you know 10 types of trades, just follow one or two. That is more than enough. Define your limits, set a maximum number of trades per day, write this on a paper, review and adjust, analyze your performance, and modify these limits. So, if you are not able to manage more than 4 trades per day, don't take more than that. When you review this, you will understand that when you are taking 8 trades in a day, you are making some profits, but when you reduce this number to 4, you either made less profits or you made more profits. Accordingly, adjust your positions, adjust your number of trades, and avoid impulsive decisions. Stick to predefined trading plan. So plan a trade and trade a plan. Plan all the trades beforehand before start of the market, even if you are taking intraday trades. That will help you. Create a plan before the day starts and follow that plan when day goes on. Write your plan for the day. If it works like that, go on and take trades. Do not think during the market hours. It may be time consuming, it may be mentally stressful. Always quality matters over quantity. When we are learning, quality must be important over quantity. Take example of learning surgery. If you are learning surgery from a bad surgeon, even if you get to do hands-on surgeries and you perform 100 surgeries, you will still become bad surgeon because you are learning from bad surgeon. But if you are learning from good surgeon and you are just observing 20 surgeries, not doing 20 surgeries. I'm saying you are observing 20 surgeries. You can learn much more from those 20 surgeries as compared to 100 surgeries which you have performed yourselves. So both things are important. Quantity is also important, quality is also important. But if you want to choose one thing or the other, first choose quality, learn quality setup, and then go for that in quantity. Avoid any forced trades, don't feel pressured to be in the market. Not taking a trade is a good trade. Wait for your ideal setups or near ideal setups. It cannot be always an ideal setup, but don't go for those setups which are bad setups. For example, when the stop loss is very big, don't take that trade. Maximize your profit potential by focusing on high probability opportunities. So, when you review your journals, when you review your trades, you'll understand your strength and weaknesses. You'll get many insights. Emotional triggers are important. Identify the patterns which are causing your emotional triggers. Leverage on your trading strength. Identify your niche, that I am good at taking these kind of trades, and focus on that expertise. Maximize your potential. This is very important. Develop strategies aligned with your strengths. Identify your strength and maximize that strength. Discipline is the most important factor to trading success. Control your emotions, stick to your plan to achieve long term success. Trader cannot stop learning. Continuous improvement is necessary. It is similar to doctors. Doctors cannot stop learning. They have to attend CMEs, they have to go to conferences, they have to go to fellowships, they have to improvise in the OT, they have to change the techniques. So, learning never stops. Embrace the process of growth. Refine your skills by continuously improving trading strategy if required. Don't make unnecessary changes. When your surgeries are good, they are giving good outcomes, you don't need to change the steps. But if your steps are not optimized, you need to optimize them. You can become a faster surgeon by following specific steps. Similarly, you can become a good trader by following specific steps. Adaptation to market changes is important. We can stay ahead by evolving with markets. Markets are dynamic, they keep changing the conditions. We have to also keep changing. Many times we are focused on the destination, but journey can also be pleasurable. So focus on the process, that will give you progress. Whenever you are making new milestones, celebrate that milestone. Embrace the challenges which are coming. There will be setbacks. Accept that setback and adapt to it. Enjoy the process. Trading is a marathon, not a sprint. Investment is also a marathon, not a sprint. You cannot become a overnight hero. You have to keep working. It is like a sprint runner. People say that Usain Bolt has run for these many minutes and he has won so many gold medals and he has made that much of fortune. But to run that those number of minutes in the Olympics or in the races, he had to practice so many hours. There is lot of background work involved even for a sprinter. If you see some trader who is making 200, 300, 500% gain in a year, that person is able to do it because there is a lot of background work. You cannot emulate it in single day or in just one course after few months. It takes time, it will take time. Don't be greedy. So everyone cannot make it, but even if you are making better than average people, you will be highly successful. Mastering fear and greed is very important. Fear is the silent killer. Understand whether this is a fear of losing profits or this is a fear of losing when you are in loss. If the fear is because of loss, when the trade is in loss, then just accept the loss and exit. If this fear is for losing profit money, then it can be bad. Then you will not be able to make big profits. One has to strike a appropriate balance. If you have fear of losing profits, what you can do is partial profit. If you are having fear of losing money because the trade is in loss, just exit the trade and take the losses. This will help you a lot. Similarly, greed can be profit eroder. So when you have a greed that probably, even though I am in losses now, I will recover and after that I will exit my trade, then that greed can be problematic. If the trade goes in losses, you will make further more losses. But if you have a greed that I have made good amount of profit and I want to make more profits from same trade and I will buy further more in this. This can also be disastrous. Suppose you have bought 100 shares initially and now you buy 1000 shares and stock moves against you even with small points. Then all your profit will be gone and you will be in losses. So identify these factors. What is this greed for? Is it for making more money or is it for preventing losses? Act accordingly. Balancing is the key. Identify the sweet spot between risk and reward. Identify the sweet spot between fear and greed. And this comes only with experience. I cannot give it to you ready made. Patience has a big importance. One has to be like a farmer while investing. Farmers have their process. They keep on repeating same process. They will plow the farm. They will throw the seeds and they will follow the same method. Results will come automatically. They will remove the weeds and let the profits grow, like let the grains grow. Similarly, we need patience during our investments, and it is also true for trading. One needs to have a patience to sit till the time is good to take a trade. As long as setup is not formed, don't try to jump in. When the setup is formed, take the action. If farmer keeps on sitting even after raining and he is not able to plow, what will happen? He will not be able to get any profits. He will not be able to get any crops. Actions have to be taken at right time. So plowing has to be done before raining. Seeding has to be done when it is raining. Similarly, we have to wait for our setup and act accordingly. Take the trades only when the time is ripe and trust the process. Believe in your trading plan. If you believe in your trading plan, then only you will be able to reap the rewards. Farmers are not able to make profit every year. Sometimes they will have average crops, sometimes they will have below average crops, and sometimes they will have very good crops. Similarly, in trading also, this thing happens. But with time, you will be able to adapt to the conditions. When we follow the plan, when we follow these setups, then the confidence is built. Knowledge is power, and educate yourself on trading strategies. You have already done this. Now practice and build skills. Practice with tape reading tool, with bar replay, and with forward testing. Then take smaller trades and then finally go to full size. Experience breeds confidence. Once you gain this experience, then you will have much more confidence and your psychology will improve significantly. Dealing with trading losses is very important. Losses are part and parcel of the game. Accept that losses are inevitable. If you don't accept this thing that losses are going to happen, you will keep searching for new methods, and one after another you will keep searching for either a method or a course and you will keep losing money. So just identify that losses are part and parcel of the game. Keep the losses to smallest possible and do not let them go beyond your control. Learn from your past mistakes, analyze losses to improve future trades. So loss making trades analysis is more important. If you understand one thing which is recurring in the losses, just remove that thing. Your results will improve significantly. Continue repeating that thing which is giving you profit and remove those things which are giving you losses. Don't chase losses, avoid emotional trading. Positive thinking has specific power. Focus on positivities, celebrate your wins, and learn from losses. So how can you celebrate from wins? If you make very good profit, then reward yourself. Buy something for you. Go on a trip. Go on a holiday. Do something which you like the most. Visualize your success. Imagine yourself achieving your goals. This is very important. So, what you will do when you will make profits? Imagine that thing. This has very good impact on your trading. Don't be shake chilly. Be practical. But imagine when you will make good profits from trading, then how will your life be? How will you improve yourself? How will you reduce your stress making work? How will you be peaceful? How will you be able to spend time with your family? Whatever you like, visualize that and maintain a growth mindset. Embrace challenges as opportunities. And building support system is very important. Connect with other traders, who are of similar mindset. Those who are following same method, connect with them and discuss with them. Share your experiences and learn from others' experiences. Seek mentorship, learn from experienced traders and build a network. Surround yourself with supportive individuals. Don't surround yourself who are loss making people, or those people who are not supporting you, or those who are not disciplined. If somebody is not disciplined, try to avoid that person. Rest and recovery is very important. Avoid burnout. Take breaks from trading to recharge. I have done this many a times. I don't take any trades for few days. So this helps to recover and rest. If you are in big losses, just exit all trades and come out of the market. Later on, you will get opportunities. At that time, start again. Maintain the perspective. Step away from the charts regularly. It should not become monotonous. Trading is boring, but chart analysis should be your habit. It should be your passion. It should not become stressful. So sometimes you can go away from your charts. When you come back, return refreshed. When you are on holidays, just shut down your system. Don't look at the charts. You must know that it is said that FIs sell everything before Christmas and they go on holidays. So that way you can also do. Don't watch stocks. Don't watch anything related to market. If you are on holidays, enjoy your holidays. That will be more refreshing. Come back with clear mind. So mastering trading psychology is a lifelong pursuit. Develop resilience and emotional control. Focus on discipline. Stay disciplined and stick to your plan and learn continuously. These are very important things to master your trading psychology. And unless you have some method, either technical analysis or fundamental analysis, you cannot master your psychology. This is very important. So, those people who say that technical analysis or any analysis method has less importance than psychology, they are wrong. You cannot improve your psychology if you don't have a method. Everything has equal importance.